Hi, everybody. As you all well know, Sean and I are trying to always bring you value. And one of the best ways to bring you value, as you know, is to find historically money-making strategies that are hard to access, but at the same time, really are so compelling, especially in this market environment where I believe 30 to 50% now even of all shares traded are traded in some type of algorithmic or formulaic way. And here we are trying to bring that type of strategy with the proven track record all to you. And now to talk more about basically further how we're enhancing that, Sean, I'll turn it over to you.
Thanks, Greg. And very excited to have Michael here with us today. Michael, welcome. And do you want to just tell the audience, for those who don't know you, a little bit about yourself?
Yes.
Sure. Thanks for having me. Look, I am 54 years old. I've spent my entire working life in the financial markets, including a long stint at QIC, where I was initially an investment analyst, then portfolio manager, and the 2IC of the equities area. I got to a point in my career where it was important for me to try and do something different, and I started a boutique, which I really enjoyed. But it also got me started on a mathematical way of investing. And today we have what's called Stock Nostradamus, and that's really the topic of now.
Thanks, Michael. So I'm just going to give those of you a little bit of a background about how we've joined forces with Michael and what we're trying to do here at Ignite Equity and now 180 Markets as well. So we met Michael about a year ago, and he told us his success rate. And I'm sure, like most people, we just didn't believe it was possible.
No way.
I think Michael at the time had a 99% success rate. So what we did is we tried it, we tested it, and about 8 recommendations later, Michael's record was still intact. So we then thought, how can we bring this to our network without jeopardizing Michael's? Michael obviously has to earn money too. So after about 8 attempts of different stock tips, Michael's record was still as good as what it was. And we thought, how can we help Michael monetize this? So Michael has a platinum and a silver recommendation. And we thought we'd offer all the platinum recommendations to those that are signed up with us at Ignite Equity, and we'd pay on their behalf. So that has now been running for about 3 months, and you haven't had a loss yet, have you, Michael? No?
Nope.
You do
have one in 7 years.
It is amazing. So, it's been a great start and for us. And we're pleased to announce that we are extending this offer to all 180 Markets members. And if you open up a new trading account with 180 Markets, you will also receive these free tips that we have paid for, but you won't be paying that $85 that Michael charges. It'll only be platinum recommendations at first, and we're very excited to continue our relationship with Michael.
Yes. And speaking of Michael, obviously, Sean's talked about your track record and our experience with it, which is certainly outstanding. Maybe at this point, can you go a little bit deeper? You do have a presentation just to talk to people a little bit more about how you can do it, because certainly the number one question is, how does it succeed?
Sure. Do you want to cut to the presentation to that second slide? And yeah, we'll just slide right in.
Hang on 1 second, everybody. Here?
Perfect. Now I'm going to fly through this, but you can slow me down later. The reality is investing is a very difficult thing to do, and reacting to published information when I first started in the industry was a big thing that you could do to make money. But these days, with the advent of net and email, the reality is groupthink means no one makes money because everyone's doing the same thing at the same time. And secondly, and this is more prevalent than ever, behavioral biases have become a very, very important facet of our market. Indeed, people freeze when they should be buying and they get greedy when they should be selling. Our aim is to be intuitively investing, that is buying low and selling high. But unfortunately, lots of folks caught in buying high and selling low. That's not what we want. So imagine this, fund managers struggle to make money, and that's well documented.
Yes.
What have most individuals got? So next slide, please, Greg.
Yep.
What we do, and this is a nutshell of a lot of work, but we measure, interpret, and track changes in volatility, and that's based on our proprietary work of what a volatility index is. And we work exclusively over the ASX stocks. There's about 140 of them that we offer. What we know about changes in volatility is that they predict a future share price behavior, believe it or not. And that means that we can simply buy ahead of a rise and sell ahead of a fall. And that's really, in a nutshell, exactly what we do. Now, one of the things that I mentioned was reacting to information doesn't work. You'll notice we are proactive. We don't actually react, we are proactive. We're not emotional. Mathematics has a hard time being emotional. So we're very different from what everybody has ever done. And that means on the next slide, we're able to eke out these beautiful returns. Now, I've given you there's a lot of information here, but the 1 year return, 14.5%, the 7 year return, 17%. They've both got an almost perfect track record. And one thing that I want to introduce, and I've never talked about this that much, and I'll show you a chart in a minute, but our paper loss average at the low, the worst it gets, is 10% in the last year. And over the last 7 years, it's 11.7.
Michael?
Yes.
Just to ask, so just to clarify that, is that across on a portfolio basis or an individual stock pick basis?
That is the individual stock recommendation, the lowest point between the buy and the sell.
Right. So in other words, you buy shares in BHP at 100, they would go down to 90 or a little bit, 89.3, and that would be it. Okay.
Yep. That's the average. Okay. So in averages, there's a range of opportunities. Sometimes it's +2, sometimes it's -22, but that's the average.
Understood.
Okay. Now, next slide. What is it? Why does this happen? It's simply this. What we're doing is predicting share price behavior. So we're predicting a change in behavior. What that means is that we're recommending buying when things are uncertain. And when things are uncertain, people are irrational, they're generally panicked, and share prices overreact. And therefore, once we've purchased, there is always the possibility that share price continues to overreact. And,
Sure.
and therefore, when we're using these behavioral aspects of the market panicking, we're getting the benefit of getting in, but we also have a little bit of time to pay. Now, as I said, we're trying to buy low, which is using that fear, and we're selling high, which is using the greed. But the price for being able to earn almost 15%, 17% in these trades is that you can endure a little bit of paper loss along the way. Now, that doesn't worry me, but I know it does worry some people. Next slide, mate.
Yep.
Now, this is just a chart that I copied off our website this morning because I thought it'd be great to show this pictorially. Doesn't matter what it is, but this stock, we purchased at $28.15. Leading up to that, it was a turbulent time. You can see that the share price went down to just above $25. Now,
right.
Our stated aim, and you'll probably hear me say this a couple of times today, is to buy in the low 10 to 15% of a price cycle and sell in the top 10 to 15% of a price cycle.
Right.
And that's indeed what this shows, just by happenstance, but it happens time and time again. Now, this stock's done more. Yes, mate.
And I think one point to highlight here is fully expect that when you're buying something, it's not necessarily the bottom.
That's exactly my point. Thank you for highlighting that. Okay. It would be a perfect world if we bought it today and it never ever went down. but equally we're achieving results that people dream of. So there's a little price to pay along the way.
Right.
Now, if you can see bottom left where we've bought, top right where we've sold, we've bought in that low 10 to 15% of the price cycle. We've sold actually in almost the top of the price cycle here. But what that means is we're capturing that 70 to 80% of the return. Now, in this case, it's more than the 15, but that doesn't matter.
Right.
The point is that just showing you that paper loss aspect. And in the next chart, Greg,
Right.
ask your question if you got one.
No, go for it. Carry on.
Good. Now, this chart I've never shown anyone before. I'm going to just run you through the base because it's worthwhile just making sure it's obvious. Firstly, the scale is from plus 45 to minus 55. The top line, the blue line, is the profit. And of course, we've got the stocks running through the middle. So if you just look on the left there, XRO, which is 0, made just shy of a 25% return. It had a paper loss of 30% at one point in time, 1 day, 1 hour, whatever it was. Now, what I then did was I ordered all the stocks. This is from last financial year, from the worst paper loss to no paper on the right-hand side there. And the point here really to stress is a paper loss, if you do the mathematical correlation, if you want to be a boring geek, but unfortunately I am, the correlation is minus 0.35. That means it's an inverse relationship and it's a weak relationship. Otherwise, you could easily say, ooh, I would buy everything that made more of a paper loss and hope for a bigger return. The facts are paper losses don't correlate to actual losses. Every single one of these made a profit.
Right. And we're going to also, by the way, everybody, Sean is going to touch on it at some point, that it's not just that we're on a computerized system here. Sean has actually tried and true these picks. So it is the real deal. Keep going.
Absolutely.
Michael, I'm going to ask you a question now I was going to ask later. You're kind of in the middle of answering it. So I guess now's a good time. I was going to say, I've never seen a stock system without stop losses. This is the first one that I've seen. And that's my biggest fear with what you're doing is, are you worried about a day where you could have a 50% loss with one of your recommendations?
If we could reflect on COVID and the way the system coped with that, no, I'm not. But let's address the question. I actually did some reading in Forbes, which are usually fairly informative as articles, and they had a statement which says a stop loss order takes the emotion out of selling when an arbitrary price level's hit. That's technically what a stop loss is.
Right.
Now, what we do is we play for capital gains. We don't play for making losses. And as I said, we buy in volatile times and we sell in when the sanity prevails. Now, it seems to me that a stop loss is a rational way of making an irrational decision, because what I've displayed there and the history of 7 years is there's no loss. And a loss on paper means very little. So does it worry me? No, it doesn't. It's not something that I consider. I know I'm used to being a bit different, guys, and so I'm also doing things the way that I know works. And I bet you comment, but it seems to me that if you've got a data set that shows you no loss, what have you got to fear? However, you've got to be able to do whatever you want to do. All we're doing is providing the advice. And it's asset license, general advice. We don't take consideration of your financial position or snowy on the trams. It's just what we do, and that's how we roll.
Understood. Should I keep going?
Yes, please. Does that answer you, Sean?
Kind of. Yeah, I guess.
Yeah.
You're a brave man.
Come back to me if your question gets extended.
Sure.
So there's a great old investor in the US called Warren Buffett, and he made this statement this year actually, and he says that investing requires a certain attitude, not a technical skill set. And this is where this behavioral bias and behavioral finance comes such an enormous impact, because humans are hardwired to be emotional. They're panic merchants by their nature. And you might want to believe that a price is going to go down, bottom left to top right, and that's all that happens, but that's not realistic. So standing against the crowd, as I say, is not for everyone. And if you've got those emotional biases, it makes it very hard to buy low and sell high. And I'd say that if people are struggling with the attitude of standing against the crowd a bit, knowing that investing's tough, then you've got two alternatives. You either do it the old way or you try something new. So just the next page there, Greg.
Okay.
Thank you, mate. So Warren Buffett wasn't talking about us, but he was talking about a technical skill set. And we are effectively a technical skill set. And as I've said, we recommend when volatility visits the market, and we look forward to those times. Once we've got the price behavior nailed, we'll purchase ahead of it. And because we're based on volatility, and this is an important point, we're attracted to it. The worst market for us is a dull market when share prices are going nowhere. Our opportunity to exit is when uncertainty falls, and then share prices naturally rise, like we're going through a bit at the moment. And, I call our methodology the Holy Grail. On the next slide, just a reminder of exactly that track record. I've approximated that to 15% over the long term and 99% over the long term. As I've mentioned and hopefully demonstrated a bit better, paper losses don't mean anything. What we've also demonstrated is it's about staying the course. So if you're going to buy with us, then sell with us. And maintaining that attitude is the thing that we really want to stress. Now on the next, yeah, go on, mate.
And everyone, just to clarify, our R squared of 0.35 generally above 0.8 is considered statistically significant.
Yeah. So this is technically considered weak.
Right.
Okay, next. Okay, so look, when I was a kid, there was following the bouncing ball. Probably you guys are too young to remember that. But what I'm saying here is reacting to information doesn't work anymore. We know that behavioral biases are dangerous, and Warren Buffett stresses that for us as well. We've overcome those issues using maths. I'd stress to you, anyone can buy. Anyone can buy at any point in time. Few can really sell well, and that's where we really do make our money. In fact, we could give away the recommendations to buy and just be there to tell when the sell is. And in some ways,
Wouldn't advise that, Michael.
So we know how to make money, and the reality is, what I'd like to stress to anybody when they get nervous about a share price being down is, if you've committed to buy with us, just hang on, because the incidence of history, the incidence of probability, and a 99.5+% profit rate is going to give you the payoff that you need at the end of the day.
Yeah, Michael.
Next. Yes, mate.
Just before that, I can't resist just asking Sean a question about this factor. No pun intended. That really was a slip. One of the ways to handle yourself emotionally is position sizing. Can you just talk a little bit about getting a position that's big enough to be meaningful, but small enough that you can handle the movements?
Sure.
Sorry to divert.
No, and I think that this can apply to Michael's strategy, but I find that I hold on to my smaller positions for a lot longer. I find that my bigger ones I watch a lot closer, and when they're in profit, it's harder to let them run because you start selling out slowly. Whereas the smaller ones you can take a lot more risk with. So size does matter. And yeah, it just depends on different scenarios.
Yeah, but I think it's a critical point.
I think it's a good point. And, the reality is, even though that's not what I do now, I ran the small companies fund at QIC, and I was backup manager on the property trust portfolio and on the big portfolio, the $10 billion big boy. And the reality is sizing actually makes quite a difference. But that's not what I do these days. But I think you guys have got some good strategies you can share. So that's great.
Okay.
Look, I think if your bigger positions do well for you and your smallers don't, I think it's pretty obvious what happens. So carry on.
Yep. Next slide, Greg.
Okay.
Told you I speak fast. So now on this, our investment timing indexes, which are what we call the volatility indexes, lead us to be stock pickers. We never force a buy. And Sean, we've had discussions about, a month or two where there was just nothing that came out of the system. And, it would be better for me if something more regularly came out of the system and maybe a few more sells at a time that might be convenient for me. But that's not what we do. We let the system have its head, and we do that because we want the purest decision possible. It would be totally wrong of me to try and weigh in over the top of what this does. We wait for the opportunities. We keep cash in the bank. I've never been fearful of having cash levels, even 70 or 80% if I need to, and then wait for that recommendation set to rein in. And it comes, like June, where we had quite a lot of recommendations that have come forth.
So Michael, let's sorry, because that's also where one of my questions was heading. If you keep cash in the bank and you get a patch with a lot of buys, which you do have, like we probably about 3 weeks ago, there was about 8 to 9 over a 2 to 3 week patch.
Yeah.
How do you allocate your funds then? Because you cannot use a portfolio approach where you put in a tenth of your portfolio in each position, because at certain times you may have 15 to 18 positions open.
Or 5.
Or 1 or 2.
Yeah.
So how do you, what do you say to people who have a portfolio approach, and how do they allocate their funds? Because just to note on that, I would only, we are buying every one of your recommendations. I don't feel that it's, I don't think I'd gain anything by looking at a recommendation and going, that doesn't fit in my strategy, because most of them don't. And who am I to say that I know more than what you're picking? So how do you tell people then to to allocate their funds for this?
Sure. Look, given our licensing, we don't have an ambit to make a comment.
Don't worry, ASIC's not listening, so you can.
What I do is I have, let me think, I would put between 2 and 4% into each recommendation. And remember, from a portfolio point of view, I'm not actually afraid of having many positions. And so I've been used to running large portfolios with large sums of money. Not that mine's all that large, but that's the way I think about it. And I think about it in a very generic sense, in that it's a platinum, and I put the same money into a big as a small, because I believe the power of the big or the small will give me sufficient return. So that's the way I view it. I'm sure everyone's got a different point of view. I'm sure lots of people, I have had people say to me, I'm just going to put all my money into one recommendation. And I've always said, look, I wouldn't, because I believe in diversification.
Michael, just on that, if we go back for as long as you've been doing this, do you know what the most amount of live recommendations you have had open at one time is?
I don't.
Okay.
I
at the moment, there's quite a few.
Yep, there would be. And as I say, in the start of this slide, we're not forcing a sell. We're also not expecting that people will take up every recommendation. What I find is where we disclose that it's a financial stock, people say, well, I already own financials, or I don't like them. Or it's a resource stock, same. at the end of the day, that's their choice. So what we're trying to do is give the opportunities as they arise, knowing that in time they'll make their money. And certainly for me, I get to points in time where I've got too much invested and I have to miss 1 or 2 or 3 or 5 or whatever the number is until the opportunity to release some cash comes.
Understood.
Yeah. So, you know, that pretty much finishes that slide there. As I said, I've been a portfolio manager. I know what it's like, but we couldn't have that service for such little money. Now, look, this slide here, we can leave this, but what we're saying is that there are lots of ways to make money. There's lots of hard ways to make money. We're making it easy. We're allowing you to turn over your capital. You've got great success rate, good returns, a lot of sectors, a lot of stocks, and we're overcoming some of those major challenges and making money. So that's really the summary of what we do and how we do it. And I'm open to more questions if you have them.
Yeah. Thank you, Michael, very much. Obviously, the record is very impressive. Before we close, though, on that, speaking of record, and obviously everything we've shown you is theoretical, but it's actually not theoretical. And Sean, maybe you want to talk a little bit more about how we can prove that it's not just in theory.
Well, what we are going to be doing is opening up my little Excel spreadsheet and going through all my trades since I started with Michael. It won't be on this call because this call is almost hitting the time. But what I want to do is when we don't have Michael with us, we're going to give our honest thoughts on what Michael has done and show his stock recommendations to date that we have purchased. That will be available for all 180 Markets members on the platform. So it is free under resources. That'll be on there probably when this is, once this interview is posted. Michael will not be allowed to look at that.
I already know the results.
Yes, exactly.
And then, as we said before, we're excited to invite all 180 Markets members along for this journey. And all you need to do is open up a brokerage account with us. Now, we will not just be sending out the recommendation because that invites free riding and something that Michael, and we've discussed with Michael that we want to help him monetize this a bit more and get more people across it. So you'll obviously have to buy the stock through us, and then we help Michael. We'll reimburse him for part of the cost.
That's right.
And we will be paying him an upfront fee as we have been with Ignite Equity. So, Michael, let's hope we can continue the success together. I'm not looking forward to that first loss. I'm sure I'll give you a call and go, what's happening here? You obviously don't think that that'll happen, but
I'm not worried.
We like confidence.
Yeah. It's definitely a great way to diversify your portfolio and completely different to what we're doing here. So excited to continue.
Yeah, and just in conclusion, everybody, I can't stress it enough. This is taking the next interview. We'll be showing the theory into the really. And when you see in Sean's spreadsheet, it will be the really.
That's right.
Okay, everybody.
Thanks, Michael.
Thanks.
Thanks for your time, guys. Have a great day.
Bye-bye.